Okay, welcome to another video. Very short, quick video today. I want to talk about dollar, Japanese yen once again. Now, let's just jump straight into it. We have had quite the pullback from 160. This is a year-to-date chart, and I particularly want to talk about Bank of Japan and some of the potential outcomes for this market, what they need to do, and so on. So the Japanese markets are obviously closed due to their holiday. The yen, as that happened, the yen just about surpassed 160 against the dollar. Remember, this was on, and I mentioned this in another video, very thin trading volume on Monday, and of course, you know, yen being the weakest since the mid 80s at that point. And while the Ministry of Finance refused to confirm it, all signs are now showing and pointing to that it has responded with a foreign, exchange intervention, and it looks like it's around 5.5 trillion yen on Monday, and then a second intervention of around 3.5 trillion yen in the early hours of Tuesday. And if that is indeed the case, the Ministry of Finance response has been more forceful than the intervention that they had in September of 2022 when they put 2.8 trillion into the market, and then the 6.4 trillion it spent in October 22, which was the at the time largest intervention. So where does that leave us? Well, the Ministry of Finance, according to my quick maths, would only have used up about 5% of its currency reserves. So there's plenty of scope for additional rounds of intervention if need be. Obviously, if we pass 160, 163, 165, who knows the level of intervention and the size. Given that we're now trading around 153 against the dollar, those interventions have clearly, bought some time. However, a sustainable strengthening of the exchange rate is going to require a narrowing of interest rate differentials, and that can only happen once the Fed starts to pivot towards rate cuts, whether it's later in the year. It's certainly not going to be in June or July after March's surprise CPI reading that came in higher than expected. Either way, when you look at it, the economic case for preventing the yen slumping is now much weaker than it was a couple of years ago. So the Bank of Japan's reaction remains a bit of an enigma to me. The yen has taken center stage all week, but the outlook report that we had, it didn't really get the attention that it perhaps deserved. So there's a few points that I want to talk about worth sort of noting. First is the bank's analysis basically shows that the stronger wage growth isn't yet I would say, significant driver of overall, CPI. So the bank has come out and said that they think the faster wage growth does boost service prices, and according to their calculations, the bank's calculations, each 1% point tick up in wage growth tends to lift prices of general services by around 0.45 points. So if we're, from our calculations we're doing, if we're right and wage growth will be 2 percentage points higher this year than it was 5 years ago before the pandemic, so I'm talking pre-pandemic, that would only lift service inflation to around 1%. The pre-pandemic average was about 0.2%, so we're only 5 times higher, give or take, than where we were pre-pandemic. So service inflation is probably going to hold up much better than expected, and of course, better than the 2% average that they're expecting across this year and into 2025. The second thing I just want to touch on briefly is that the bank is still struggling to come up with a reliable measure of underlying inflation that isn't being distorted by any sort of impacts of the cost shock during the pandemic. So it's going to be very interesting to see, where this leads us down the line and what this means for, when you talk about why the bank has ended negative interest rates and yield curve control, when actually all of its measures of underlying inflation have yet to reach their 2% target, let alone even surpass it. So why are we jumping the ship so early, and so on? And the answer probably lies in the bank's conclusion that the real policy rate of around 1.5 to 2% falls far short of any estimate of the natural rate of interest. In other words, the policy is now incredibly or exceptionally loose. So keep an eye on this going forward. There's been a really interesting week. We actually had a short on dollar yen at 158. We've taken out most of the profits now. We've been biased from, of course, 110. We still retain the majority of that trade on. We are beginning to hedge in here. At some point, we'll be getting relatively flat. So keep an eye on that. And then finally, in the week ahead, we've got some earnings coming out and so on. So it's going to be a busy week next week. Just thought I'd make this very quick video to talk about the slump in dollar yen and what we can expect going forward. The reasoning for it, the intervention, of course it wasn't confirmed, but it's pretty much a given. And let's discuss in the future the possibility of going beyond 160, perhaps even 165. Okay, that's it for me. If you found this useful, please like it, and maybe I will do some more in the future.